Shae Russell here, editor of the Daily Reckoning Australia. I thought given that the Aussie banks are in the headlines at the moment because of the Royal Banking Commission, we take a quick look at what's happening. Now, the inquiry into Aussie banks at the moment hasn't turned up anything major. It's all the sort of usual stuff that you expect. So there's been some fake documents, some cash bribes, and some unnecessary insurance policies being sold. So nothing too dramatic. However, while our attention is focused on this, we need to start looking at what rate hikes from the Federal Reserve Bank mean for us. Now, one of the things that a lot of people might not be aware of is that Aussie banks go to what's called offshore funding, which is go to commercial banks, borrow some money from them to fund loan activities in Australia. Now, as of the end of last year, what's known as offshore lending, Aussie banks had a total debt of $750 billion, which is not, a reasonable sum. The problem is that does mean that this offshore funding is susceptible to rate increases or decreases from other countries. So when when central banks like the Federal Reserve raise rates, it actually does have a direct impact on us. Now, Macquarie recently put out an estimate that for every 10 basis points an international rate goes up, that has a 1 to 2% effect on lending margins and ultimately could have a 1% effect on bank profitability. So that's an interesting take on that. However, that assumes that the Aussie banks would absorb these rate increases. Now, if the Aussie banks did absorb these higher costs, we would probably see a reduction in bank profitability and shareholders of the banks would feel it more than the wider economy. The problem is banks don't work like that and they like to make money. So with offshore lending rates increasing, most notably the Federal Reserve Bank, banks are going to most likely pass those higher costs on to us. So what that means is that we can probably expect to receive less interest on cash on hold at the bank. It also means that mortgage rates are probably going to go up, along with general day-to-day banking rates. Now, we're not going to notice these effects at first because they will be quite minimal. But eventually these higher costs will be passed on to consumers and consumers will feel them. So what does that mean? That means that we will start to see less consumer spending. And the less consumer spending we see, the less global growth, the less local economic growth that we're going to have. So basically, higher banking costs generally lead to a tightening effect on the economy. What this does mean though, is this adds weight to the case that the Reserve Bank of Australia is even less likely to raise interest rates this year. So in effect, every time the Federal Reserve Bank raises rates, you can pretty much make the case that there's even less likely of a chance that not only will the RBA not raise rates this year, but there's a really good chance with these higher international costs that they're not going to raise rates next year either. That's all for today. As usual, if you've got anything to say, pop it in the comment below and make sure you subscribe to our newsletter, The Daily Reckoning Australia. I'll see you next week.